Welcome to the E-Commerce Finance Podcast. I'm your host, Stephen Brown with Ledger Gurus. In this episode, I have Alec Koenig, CEO and founder of 𝗧𝗸𝗆. We're going to talk about lending to e-commerce as well as inventory challenges and that are related to e-commerce. Alec, thanks for joining me.
Thanks for having me.
So Alec, give us your background in e-commerce. How did you come, what was your journey to founding 𝗧𝗸𝗆, which is a solution focused on e-commerce? And maybe you can talk a little bit about your focus.
Yeah, so prior to 𝗧𝗸𝗆, I was the head of credit at a company called Affirm. You've probably seen it on the checkout of various e-commerce websites. So I was there from 2015 to 2019. So that kind of gave me my first foray into e-commerce businesses and the challenges they face and how they're using Affirm and other products like that to solve some of those challenges. After I left Affirm, I started 𝗧𝗸𝗆 a few months later, really with the view of improving accounts payable experiences for businesses. And then my foray and my background is all in credit and lending. So I was like, well, instead of just making a better software tool, can I actually combine this with working capital to change the trajectory of these businesses instead of just saving them a few hours a week? So that was a thesis from day one. We started the company in late 19, launched in summer of 2020, which turned out to be the middle of COVID. And what we quickly discovered was as the offline retail channels shut off, everyone came online and the merchants weren't prepared for it. So they were stocking out of goods left and right. So by being able to offer working capital in a fairly quick way, we're able to find product market fit very quickly and help a lot of these brands out and getting all the goods that they need to deliver to their customers.
Now, you have a history in lending. Weren't you somewhere before Affirm as well?
Yeah, so I started my career at Capital One for 6 years. Did many different things from auto loans to personal loans to retail bank accounts. Then I got really infatuated with startups, so I joined one in LA, which was focused on mortgages. Did that for about a year and a half, and then found my way to Affirm.
Why, lending is very difficult for e-commerce businesses. With all of your background in banking and lending, why is that?
Well, I think generally the failure rate of small businesses and by extension e-commerce businesses is fairly high, especially the smaller scale that you go. So I think that's part of it. Another part of it, I think, is just how capital intensive the businesses are, namely having to procure inventory way ahead of time of actually selling it. So that makes it very challenging. And I think the other thing is being in you don't have to be in e-commerce. You could also be in other channels as well, but being in e-commerce, things change very rapidly. So Facebook might change an algorithm, or Apple might change a privacy notification that changes the ability to acquire customers the same way. So things can rapidly change, and I don't think e-commerce is prone to other macro things, but things like COVID and tariffs have also definitely played a role. So including the banking crisis that was when SVB collapsed, I think founders of the last 5-6 years have lived through a lifetime and just want a little bit of stability here.
So let's talk about Affirm for a second. The founder is it Max Levchin? Is that how you pronounce his name?
Yeah.
I've heard his story that he started Affirm partly because he couldn't get lending personally and felt like the whole industry was broken. So he started Affirm as a way to enable people to get credit where they struggle. There's kind of a parallel. You're kind of doing that on the business end, right?
Yeah, for Affirm, actually, the initial idea was, this was before my time, but the initial idea was to actually just provide better underwriting so they could sell it to other lenders. Because, FICO was 50 years old or something. Not saying every lender was just using FICO, but a lot of them were, especially banks and community banks. So initially they wanted to start out just providing better underwriting using, the latest machine learning models, more data. They just felt the industry really hasn't progressed that much. But the banks were like, well, if you're so great, why don't you just prove it and do it? So that's when they started, lending to consumers. And, the real special sauce of Affirm is how they actually distribute to customers. Instead of spending a boatload of marketing to find each consumer, they're plugging into these merchants' websites as a distribution point, which makes it very cost-effective as a way to acquire customers. So,
as far as has that thesis proven right? Like, do they have a better underwriting model?
Oh yeah. When I was there, and I used to work at Capital One before, which is probably even more tech-forward banks, out of the banks, and the team they built, talent, the models were just next level. I haven't been there for a while, but fairly confident they're at the frontier of what's possible. So they just built amazing models that they perform much better. They also had benefits of FICO. I'm taking a little step back. FICO is a little more of a general model, so trying to predict if someone's going to go bad over a 24-month period. So if you're able to fine tune into a segment and just optimize on that, if you're able to predict delinquencies over a shorter time period, which Affirm was, then you're able to also find lift between other models. So that's what we're trying to do here at 𝗬𝗨 as well. We're taking a very industry focused approach, just going after CPG brands. We do work with other customers, of course, but that's our main focus. And by having a product that's shorter duration, we're also able to model things better that's fine-tuned for our customer. So naturally, we're going to be able to outperform banks and other lenders in that fashion. So at Affirm, the underwriting model was definitely the brain of the business. Here, it's the same, including the people that do the underwriting in addition to the models. So that's what really makes the flywheel fly.
E-commerce business lending, the landscape's really interesting. I feel like the traditional lenders, the banks, the credit unions, for the most part, don't like to touch these businesses, and if they do, they don't typically provide enough capital for what their needs are. And then so you get this other, I would argue it's predatory lending from the merchant cash advances, the Shopify loans, Amazon loans, PayPal loans. To me, they seem really predatory because they don't seem to be doing much underwriting. They're just looking at sales metrics. And I feel like you guys are in the middle. Definitely not as expensive as MCAs. You're not quite as cheap as a bank, but you guys extend very large lines of credit. Tell me about that risk, because, and maybe before I do that, here's one of the classic examples in e-commerce was Ampla, right? They got out over their skis and they were really focused on e-commerce and went boom. So how do you guys balance that risk of lending versus making sure you can provide to good companies? And obviously there might be some secret sauce, but tell us what you can, how you are able to do underwriting better than the alternatives.
Yeah. So what I was thinking about, even at the time of starting 𝗬𝗨, how are we going to actually lend to these businesses? On the consumer side, reports are prevalent. There's so much data in them. They're so accurate. So every single consumer lender uses the credit report and the data that provides. On the business side, there are business credit reports, but no one really reports to it. So it gives you a very inaccurate picture of a business. So they're fairly useless.
Is that your Duns and Bradford?
Yeah. So Duns and Bradford is usually more so for like, hey, who's the owner of this business? How long have they been in business? But it's not going to tell you this person is delinquent on some payment, AP or loan, because no one really reports to the credit bureaus. I think that's a big opportunity for someone to actually get create like a proper business credit reporting agency. Is going to require all these lenders, including ourselves, to report. But I think that's a big opportunity for someone to tackle if they can, and maybe even do it on the blockchain. Who knows? So when I was thinking about, okay, how am I going to get access to these businesses and how they're performing? Well, okay, I could get their payment processing data to get a view of sales, but now I'm really missing, all the costs of the business. Like, what are their margins, or what are they spending on payroll, or what are they spending on marketing? I'm not going to get any of that information. And then the balance sheet is also important. What's their runway? Do they have other liabilities? How much AP do they have? I was thinking, how do I get to this data? And it's like, okay, I got to get to the P&Ls and balance sheets of these businesses. So if we build an AP product, naturally I'm going to plug into the QuickBooks, Xeros, NetSuite of the world. So I could record all these vendor payments that I would be making for them, enter the QuickBooks, and then that would give us access to actually be able to underwrite these businesses better. So that was the big unlock for us, where if we get a customer to use our product, then they're going to stay connected on the accounting side, which then will allow us to actually underwrite these businesses better. And I think there's a lot of additional things we could do. Additional data we could get. We are connecting customers' bank accounts as well. That'll give us a little bit more recent data. But obviously, accrual accounting, I think you would agree, accrual accounting gives you a better understanding of a business than just a cash basis. So the bank data is cash basis. So we're trying to piece those things two together. And now we're getting into other data sets like inventory management. So we could get SKU level data instead of just one line item on the balance sheet that says, this is how much inventory I have.
In our experience, accrual accounting is much more difficult for these businesses early.
Yeah. Yes.
And there's a lot of bad accounting. And even those of us who are good at it, it's a struggle, right? Because there's a lot of information that needs to flow to us to do it right, which is why we've been fascinated by what you guys have done, tying these things that don't feel like they relate together. And yet when you sit back and say, well, AP, usually lending is for inventory. You guys are doing a lot of inventory management stuff. It all relates. It all makes sense.
Yeah. And we are a lender. Our whole second side of the business is the software side. And to be honest, that's where 90% of the resources go. So our view is if we could solve problems on the software side, namely, inventory management, order to cash, AP, purchasing, then we're going to be able to acquire customers at a much higher scale, even if they're not borrowing from us. But as we get their data, now we're able to provide them offers for credit when they need it. And as you mentioned, one thing being for us is our APRs, yes, they're higher than banks because, hey, we don't have deposits to lend from, but they're always going to be cheaper than these merchant cash advance companies, the way we're structured. So that's the kind of middle ground that we're playing in.
It's been a turbulent year, 2025, with all the tariffs. What are you guys seeing any trends across the data, across the customers, as the years progress and as tariffs are starting to kick in?
Mostly buying trends. I think a lot of companies, after Trump came in office, acquired more inventory late last year and early this year, assuming tariffs would come into play as he announced them. So they're able to get ahead of it. And now what we're seeing is customers rejiggering their supply chains to not be fully exposed potentially to one country. I think the more mature companies are able to do this. The less mature companies, it's harder. But even with them, we're seeing them renegotiate contracts with their vendors, so they're the brand themselves don't have to eat the full burden of it. So that type of buying behavior we're seeing, and I think if tariffs are good or bad, that could be debated. But I think the way it's been rolled out, where any day it could be a different number, it makes it very hard for these businesses to plan around it. And I feel for them. We feel for them. Because you have to pull up Twitter to see where the puck is going, and even then, it might change last minute. So it's very just difficult to plan around it. So I think customers are taking a very cautious approach.
Yeah, we one of the things that we did a couple of years ago is we bought a small direct-to-consumer brand. My partner here at Ledger Guru is Brittany, who's also my wife. We and a third partner bought a small brand. We wanted a laboratory where we could test solutions like 𝗀𝗘𝗏. We've used that as a opportunity to train and learn and test, and we've really enjoyed it, given us an opportunity to kind of put it to work in a real-world environment. But yeah, this whole year, me and my operating partner, the other third partner who runs that business day to day, it's been this roller coaster this year. We're importing from Italy, and it's just like, is it going to happen? How much? When? We just got hit with our first tariff, and it sucked. We were like, dang. But we saw it coming, so we've been planning. It's still relatively small, but we were kind of gaming it out. Like, well, what do we do if it's this much? What if we do, and for a while they were talking about 30% tariffs, and we're like, crap, dude, that could be catastrophic to us.
Right.
Now we see a path forward, but it's still really painful. And
But
I'm thinking,
don't you feel
Go
like
ahead.
that really helps you understand customer pain points versus just reading about it? Like you
Oh,
actually
absolutely.
experiencing it.
Part of the thesis we had in buying a little business, I told Brittany, I was like, I don't have time. We don't have time to operate another business. But because I'm in there, I'm the CFO. Our partner's the CEO. He runs it and has a small team to help him. And then Brittany kind of jumps in on special projects. But he and I are talking every week. And I'll tell you, my understanding has been exponential. Like we had some theses on issues that we were going to experience, but until you're actually in, having to deal with those issues day to day, you don't fully appreciate the pain that somebody's going through. Now I do. Like, oh man, we're not as large as our customers. We're trying to be. We understand a lot of these. We've been experiencing the issues of marketing inefficiency, of some supply chain challenges, and now the tariffs. So it's like we bought it at the wrong time. We should have bought it before COVID. We bought it as everything was peaking.
Yeah.
And it's been just kind of hard. We've made progress, but it's been really, really hard. It's like, dang, my timing's really poor.
Yeah, but that's a lesson too, right? And you experiencing that lesson, well, the next time that comes around, you're going to be thinking a lot more about timing and valuations, right? So,
yep. Well,
I think with everything,
the thesis was we wanted a laboratory, and we've definitely got a laboratory. We not only are learning, we are feeling the pain. And cash flow is probably one of the biggest things. I appreciated it, but I didn't fully appreciate how big cash flow is an issue for these businesses. In MBA school, we did a case study on the cash conversion cycle. Yeah. It was Dell. How they'd done all this supply chain engineering to come up with a negative cash conversion cycle. The other one I hear about a lot recently is Costco. But you have to be really big and really sophisticated to pull that off. When you're small, I just don't see a way to have a negative cash conversion cycle. Most of the time, like for us, we're spending from the time we start an order and have to put initial payment down, it's usually 2, sometimes 3 months or longer before the product gets to our warehouse. And then it takes, a couple more months to sell through that inventory. And this is something that I've been looking at a lot more closely with our customers. What is that cash conversion cycle? Which most people forget. If they've learned it once, they never want to learn it again because it's a really gnarly calculation. But it's basically the measurement of how long is your cash stuck in inventory, how long is your cash stuck between sale and receiving, and then on a positive note, how long before you pay your bills. And for most of these brands, it's all inventory. Like the calculation days inventory outstanding tends to be at least 90 days, some cases 180, depending on how quickly you're able to move product. And to me, that's just, you have to solve that problem with lending, unless you have a ridiculously profitable business and aren't growing much. Because mathematically, there's a point where you can grow faster than your ability to fund inventory purchases.
That's the curse, right? It's like, oh man, I'm growing so quickly. It's like, oh, I need more money. Wait, how?
How do I get
Even
more
if
money?
You're profitable.
I don't have enough, or I'm profitable, but I'm growing faster than my profit support inventory. And it's this vicious cycle that I don't think people fully appreciate when they get into a product-based business, is that cash is the key issue. I came from software. I think enterprise software receivables could be an issue back in the day. In services, we don't have cash issues. The bigger issues we have is just, it's people, right? Capacity. Always, it's a Goldilocks challenge. You're like, you either have too much capacity or not enough. And you're always trying to do just the right amount of work so you don't burn out people, but that you also have enough work to cover your labor costs. So every business has its challenges, but consumer products, it's cash flow. It is such a big issue.
That was the initial pitch of 𝗧𝗘. Just let's get you a negative cash conversion cycle. And for most of our companies, we continue growing with them. So as they're scaling, we're increasing how much we're giving them so they could just continue scaling.
So you guys are you guys 6 years old now? 5 years old? What did you say?
5.5, almost 6. Yeah, coming up on that.
I see a lot of large sellers that don't have savviness around maybe lendability. What are some of the top things that a consumer products business should be thinking about in terms of being lending ready?
The biggest thing I think is, which we see all the time, is, I think you should get access to financing when you actually don't need it, and start using it, because a lot of times we see, company has a lot of cash, they're burning, they're getting to a very low point, they're like, okay, I need financing to continue on. And it's like, well, you're going to run out of money. Like, you should have came to us 9 months ago or 6 months ago. And now it's like you have so little asset, like so little cash runway or asset base to like actually, make the numbers work for us. So that's one thing we see very often. But generally,
let me pull on that a little bit. I've heard the old adage: banks will only lend to you when you don't need it, but when you do need it, they won't. Why is that? Is it just a risk equation?
Just a risk equation. The way generally lending works is, say this number is way too high, but just to paint the picture, let's say there's a 10% chance you're going to default. So one could say, hey, 9 out of 10, that's great. 9 out of 10 times you're going to be successful. But for a lender or a bank, if you're going to lose 10% of your money, you're going to have to charge like a crazy high APR to make this actually make sense. So, let's say 10% is over a year, so effectively 10% APR is in loss. So you're about to charge, high 20s, low 30s to make this make sense. And if you're trying to get a cost of capital from a bank that's, I don't know, 9, 10, 11, 12%, and it's like, there's no margin here. Like, this is never going to work. I can't lend to you. And I think that's why, the merchant cash advance companies exist, because they're actually able to charge you, 40, 50, 60% APRs to take on a higher loss rate.
So is it having the cash basically showing to the institution, hey, they can hit some stumbles, but they'll have some cushion to adjust. I'm not going to lose them.
And it's just an asset. The same way inventory is an asset, cash is also an asset. So generally, what I think if you're a customer, you want to make sure, there are a couple of ratios here. There's a current ratio, there's a quick ratio. A lot of these banks use, other lenders too, I'm sure. And generally, the way you want to run your business is have those ratios above 1. So current ratio being, your current assets divided by your current liabilities. So current liabilities, liabilities due in less than a year. So you want your inventory, your cash, your AR to be more than your liabilities on that front. And the same way with quick ratio, which is, now let me take out the inventory and just look at AR and cash. And generally, you want that to be greater than your current liabilities as well. And whenever you get below that one, it's really signaling either you're going to have to turn profitable or to build this back up, or you're going to have to raise capital to be in a much safer position. And now our banks or someone else going to be able to like underwrite your ability to raise money from venture capitals or angels. Like, that's a difficult thing to do. So I think if I was a brand, that's what I would be trying to do. Just like, okay, I got to like structure this business, which is very difficult, but in a way where I always have this cushion, because, you could have one inventory run go bad, your warehouse go down for whatever reason, because it's a third party, or, marketing just went off the rails for a minute before I was able to fix it. And you don't want to be in such a crippling position. And again, 9 out of 10 times, you're probably going to be fine, but with a 10% loss rate, it's very challenging for anybody to lend to you.
All right. So number 1, get lending before you need it. And I think this is a great explanation of why. Is like, the banks need to, and the lenders need to have a lower risk option when they're lending, or else they're going to be up a creek. What else?
I think reporting is very important. So getting your accounting books in accrual fashion, accurate, updated monthly on a timely basis. Good hygiene, not only to actually understand what the hell is going on in your business, but then also to provide this to either lenders or venture capitalists or investors, whatever it is. I think that's a very crucial point. Many times we see customers come with messy books as well. Maybe they're just not updating inventory, and it's like, do you even know what's going on in your business? They probably do, but they're just not, showing that they're not looking like they do.
They don't. I'll tell you this, having worked with these businesses for years, I'd say most businesses have a pretty good grasp of their profit and loss statements, and they can articulate to you various elements of that. I don't feel like people have a good grasp of their balance sheets, because it's a little bit more of a foreign concept, and I just don't think people do the work to learn what that means, which really frustrates me. because I'm like, we're doing a lot of hard work to create accurate information, but too often I see business owners who aren't putting in the time to understand their balance sheets. And I think that's a huge mistake.
And I think another one, which is very important, I think, is to make sure you have positive contribution margins, because every dollar you put in, you want to make sure that's actually generating money. I generally like to see contribution margins, 15% or higher. So
let's define contribution margin, because I think different people might have different definitions. What's your definition of contribution margin for e-commerce?
Yeah, so revenue without, let's start taking away then the COGS, so the cost of the goods, which then would also include, like shipping costs, warehousing costs, marketing costs to actually find that customer, refunds, of course. So taking all those things into account. So really the variable costs in the business, things like, payroll, okay, leave that out.
I agree with your definition. I've seen a debate in the industry over the years. Is contribution margin before or after marketing expenses, or at very minimum advertising expenses? And my view is you should look at least the advertising expenses as part of that cost of sale. Because on an online sale, like, are you going to have that sale if you didn't spend on advertising? I tend to look at contribution margin that way, like you're saying.
I'd include all marketing costs. Now, maybe you could split it out by channel here if you want to get a little bit more accurate. Let's say you're omni-channel, you're doing some marketing for Sephora, or you're just doing online and you're doing marketing online. But I think all your marketing costs have to be included in that. And now maybe, hey, if you really, and this is just more so less from an accounting perspective, but more so from understanding your business perspective.
Yeah.
Let's say you do some marketing push and maybe you want to amortize those costs over 3 months. But I think just so you understand that you're not underwater, I think you have to include all the costs. That's what I would argue.
I think that's a fair argument. And I like to go that distance as well. Marketing, in my mind, in almost any business, but particularly in e-commerce, is a black hole. It can just suck every dollar out of your wallet if you let it. And this is something that I talk to with my customers, is like, hey, you got to be careful. Marketing people will always ask you for more money, as they should.
Oh, yeah.
I'm sure your marketing people are always saying, Alec, I need more money. I need to spend more money. Because there's an infinite amount of marketing opportunities versus like, an engineering group, or let's say a product development team on an e-commerce business, right? There's only so much. It's hard to deploy like another $1 million in product development really quickly. Whereas marketing, I can burn through $1 million tomorrow, right? I could put billboards up. I could put, advertise in every channel known to man and make $1 million evaporate tomorrow. And I think where marketing drives sales in a lot of cases with e-commerce, it's really tempting to just put more money at it, but not really look at that ROI.
And marketing efficiency is so important.
It's so important. And you're like, oh, look at all this cool creative and brand awareness. And it's like, cool. How's it moving the revenue? And this is a challenge in every business, but I think it's a particular challenge in e-commerce and consumer products.
Yeah, and I think, the most successful businesses have cracked the nut on marketing more so than anything. Product is required, yes. Supply chain helps optimize things, but, the ones that have really scaled, which I think everybody wants to scale, have really cracked the marketing side of it. Best ways where the product kind of does the marketing is just so good. Mm-hmm. But, generally speaking, not every product will be so good, because then what is good? But
even then, I talk about brand marketing occasionally with people, and I'm like, does anybody in this world not know who Coca-Cola is, right? But how much do they spend on every big sporting event? Like, literally, like, there must be an ROI because they do it, and maybe reminding people to drink Coke. But like, you would think by now that nobody needs to be reminded to drink Coke, and yet they spend a lot of money on Coke. But I'm sure there's a calculus to it. That company is not, they're not dumb. They're very savvy.
My favorite example is Visa, like MasterCard. It's like marketing. It's like, who chooses a credit card if it's Visa or MasterCard? Nobody. Like, what is going on here? But there's some purpose to it, right?
Yeah, brand marketing is one of the easiest things to just waste money on, and yet it still gets done. And I'm sure there's some like marketing PhDs out there that could articulate why. But anybody who comes to me And I've been at companies, bigger tech companies, where we talk about brand marketing, and it's just like, anybody that can explain a direct ROI, I'm sorry, I think you're full of crap, because it's very difficult to attribute. Whereas I think, in the world of e-commerce, you can a lot of times say, hey, I know I'm spending this much on Meta, and this is how much revenue I'm generating. There's a torrent of attribution tools out there, and this is kind of one of the things. I think the bigger thing, though, is just like, you got to be watching it like a hawk, because what we've seen over the years, like the beginning of last year, I don't know if you guys were impacted, but we saw in the brand we owned, there seemed to be like a Meta algorithm like misstep, and everybody's efficiency like dived for a month or two, and everybody was talking about it. I even had a friend who had some connections at Meta, and they're like, what he was hearing is they made a change and they weren't sure what broke it. And so they had to fix it. But like this is a reality.
And they won't refund you. They won't refund you.
No. If the algorithm goes wonky, or the other thing I've seen is seasonal performance. Anytime I talk to somebody and they throw a sales and marketing plan in front of me, and it shows like a flat return on ad spend, I'm like, come on. Like, there are seasons that are really efficient, and there are seasons that are not, and you have to be thoughtful about that. It's understanding that your performance is going to vary based on seasonality of just consumers as well as your business and your product. And if you haven't really thought through that, you're
months leading up to the election, ads are getting expensive because everyone's putting it up for the politics.
And January, right? They might be cheap, but they're not going to perform well because they're doing that, I forget what they call it, but they're no spend January and that stuff. So you can advertise, but you're not going to get a lot of your conversion's going to be lower. And then versus like, holidays are a mixed bag. There's competition, but there's also high consumption. So understanding those nuances, I think, is key to success.
Yeah, no. One thing we don't look at, but I was always very curious about, is if we knew, let's say, what agency they're using, would that be a predictor of success potentially?
I'm not
I would think
sure.
so directionally, but by the magnitude of that, I'm not sure.
There are some out there that I feel like have a better reputation, but I don't know. If I were to craft, I'm trying to think, what would I add if I had the perfect underwriting algorithm? I don't have the experience with you, but I have a lot of experience with like data analytics, and
I'll critique it. Whatever you say, I'll critique it.
Yeah, what would I add? I'll have to think about that. Maybe I'll come up with some. The problem is you got to have something that's easy to measure. From my experience in financials, it is somewhat, especially if you had a direct connection to the books, you can actually tease out the quality of financials to a certain degree.
Yes.
That's something that I would probably do.
We have a model for that as well.
You guys have a model for that. That's good.
Which is called like the quality. The quality score.
Not all books are equal, because there's a lot of challenges. Okay, so that's one thing. All right, I'll keep thinking. What would I do? What's my secret that I can sell to settle my secret patentable?
We'll pay you.
But there's so much data out there. This is what ticks me off about the MCAs. I feel like they're lazy. Like, all they do is they're looking at sales data and charging a lot of money to offset the risk, when they could understand more in a somewhat automatic fashion, but they choose not to. And I just don't understand why they don't.
Well, it's also adding more friction, right? So It's like, and then if you're adding friction, but this person isn't, like, are you going to see a hit conversion rate and lose deals potentially to this person, even if they don't understand the cost of the financing? It's a tricky one, because, even for us, hey, I could probably ask you 20 data connections, but at some point you're going to be like, okay, this is getting ridiculous.
Yeah, and people want to do it, then they won't apply.
And then we don't even have a business.
Yeah.
We try to make it as painless as possible as well. But luckily, we're kind of looking at data that's a little bit more encompassing. But, we're going to miss out stuff from that. How subscription businesses, I would honestly love to see cohort views. We don't have that data.
Yeah.
So that's an opportunity for us, like, going forward to figure that one out.
Well, and it's really interesting. On this note of friction, this is what I tell people when they come talking to me about lending options. I'm like, okay, here's the rule of thumb. The easier money is to get, the more expensive it's going to be. The harder it is, typically the lower cost of lending. As a general rule of thumb, I know it's not perfect, but I'm kind of shocked sometimes when people aren't willing to do some work to get cheaper lending. Because it takes some work, but it's not like impossible. They're just not willing to do it. And they're just like, I need the money now. Some of it's just a sense of urgency. They haven't planned ahead. But it's just like, yeah, take the time, fill out the forms, submit the financials, have the conversations. And if you don't get approved, learn, figure out where you went wrong and make those adjustments. But I see a lot of people that they just go with the fast money.
Yeah, there's some, I understand it because, a lot of these brands are not that many people. They want to focus on product and marketing. But I generally agree with you, but I think that's the opportunity of technology. That's why I think a lot of fintech companies exist like ours, where we're going to get the exact same data at the bank that gets probably even better, more, and it's only going to take you 2 minutes to connect, or a minute to connect. So by transforming all this data into our machine learning models and dashboard of these, we're making it very painless for our customers. We even actually see this with customers that will leave us to go to a bank, allured by a cheaper interest rate, but then they'll come back 9 months later because they're like, okay, not only were there a bunch of these hidden fees and other costs of doing business with them, but the reporting burden was insane. Like, we're spending hours and hours and hours a week just like providing reporting to them. With Settle, like, it's all connected through a technology connection that the bank doesn't have, and we're not spending any time on that. So, like, looking at the cost of the labor from that perspective and the opportunity cost, even if we're hiring a charger APR because, hey, we don't have these deposits to lend off of, the customer is saving money with us anyways. So, but that's what I think the promise of technology is. We're not going to be the last ones. There'll be other ones as well where, they're going to make this as painless, as frictionless as possible for customers. And then I think that would also spur a lot of companies to sell technology to banks to make it more painless for them, which is also an opportunity.
I think, so here's my idea as you're talking. I think it is in marketing. And I think there's enough data there if you could get access to it. I think marketing is a huge predictor for the success of a business. So if I were to suggest the next level of underwriting, I'm not sure what I'd look for, but all that data
that's what we
and
need
campaigns.
From you, Stephen. Come on, Stephen. That's what we need from you. Don't just
figure out how to connect to the. I mean,
no,
you gotta look at it.
We can. We have connections to Facebook, Amazon, Google.
Yeah.
We could plug those in. The question is, like, what would we do with it? So, Stephen, that's your job from here on out.
Okay, I got to develop the algorithm. I do think marketing efficiency, if somebody is demonstrating a history of marketing efficiency, could be a good predictor for the health of that business. Because I would argue that the profitability of a consumer products business, an e-commerce business specifically, is made or broken on marketing efficiency. Right. There's other things that can trip you up, but I think your marketing efficiency is a huge predictor of profitability.
And I think you see this even in public companies, where, when companies are doing poorly, they're either jacking up marketing because efficiency has gone awry, or starting to discount goods, which is effectively a marketing technique, to sell through inventory, which is then like a death spiral of its own. So I think, the public companies can teach a lot for these private companies.
Let me kind of just ask you some specifics about Settle. You guys are more than a lending company. You said you started with accounts payable, but did you start there with the intent to do lending? What was the roadmap?
We launched both at the same time.
You launched at the same time. Okay.
Now,
and so
the AP product then was very bare bones, not up to snuff. But over the years, we spent a lot of resources in building a really best-in-class AP solution, which we stand on. And
I will second that. We've used a lot of AP. You guys have a solid product. It's very awesome.
And we're going to continue improving it, continue innovating, so it's only going to get better. But we started with lending and AP at the same time.
And since then, you've expanded. You guys got into kind of product catalogs, procurement, the purchase orders, and now you guys have gone full on into inventory management, which, like I said, when we first bumped into you guys, we're like, well, that's kind of a weird combo. And then as we kind of stepped back and thought about it, we were like, well, this is actually really brilliant because it's all related, right?
Right.
It's kind of all around inventory. And obviously there's other issues that a consumer products business and e-commerce business is dealing with. But I think fundamentally inventory, cash flow, paying for said inventory is all related. And I think you guys have wrapped things together in a unique way.
And the added benefit to the customer is because we have this lending revenue, we can make the software very cheap. And software companies that don't have that aren't in that kind of place. So I think we're always going to be able to provide savings and more affordability to our customers because of that.
Where do you guys see yourselves going? I mean, you guys have, you guys continue to kind of, I think this central focus around the challenges of inventory in a consumer products business, to me, feels like the core of what Settle is attacking. But as you guys think about the future, and maybe not just your future, I'd love to get your thoughts on the future of e-commerce in general. It's been, you started in the heydays. We started in a few years before you, so we started in 2014. We started specializing in e-commerce.
That was the heyday.
Yeah.
Marketing was very inefficient.
We kind of decided to focus on e-commerce starting about 2017. So we saw that rise, and it just was growth and growth and growth. And then COVID hit, and it was just like hyper growth. And then since then, I still think there's opportunity, but it's been hard. What do you think the future of e-commerce is from your perspective?
I think it gets to 50% of all sales. I think it's just inevitable.
Where do you think the third-party seller lives in that? Because you could argue it's all on Amazon, it's all on Walmart.com, it's all, where do you think the third-party seller is in the future?
I think they exist. I think, if you kind of look at Shopify as a stock relative to Amazon, Shopify's performed better. And I think there's a reason for that. And I think that's going to continue and exist. They're going to be able to acquire customers directly. They'll also be selling on those channels at some point in their maturity, but I don't think that goes away by any means. Everyone is, telling their own story and providing value. And so I think they exist. And yeah, I think generally we go from, 22% of all sales to 50%, just like it's in China. I think Gen Z and younger generations who are more, prevalent to shopping online, I think that's just going to continue. And I think the delivery of goods to customers is only going to accelerate. So it'll be even more convenient for all these customers. I don't see, the third-party sellers ever going away.
And how do you guys see 𝗬𝗨 evolving as the market continues to evolve?
Faster, cheaper, bigger. And I think, the next foray for us is what we're starting on right now. It's really the order cash and then AR. That's I think the missing piece for a lot of these businesses, especially when they start selling in B2B channels, omni-channel, which is just required. So I'm very excited about that. It's been planned since day one, and we're finally getting to it. So I am ecstatic. And then just, I'm sure we'll find another expansion area, but I think fine-tuning all those modules effectively into something that's one very cohesive that works together, and you don't have to spend a lot of time reconciling between different systems is the dream. And just like everybody else working on AI, so are we. It's the right thing to do. We could provide a lot of value to our customers given the pipes that we've built, the data that we have. We're creating AI agents that these brands could hire to make their lives easier and more efficient and do more with less. I think continues, and I think you'll probably see 10 years from now, a lot of these businesses are probably run by one or two people. And, the cost structure just goes down and down for these businesses.
Awesome. Well, thanks for joining me today, Alec. This was an awesome conversation. If somebody wanted to connect with you or with 𝗬𝗨, what's the best way to do so?
LinkedIn, Twitter, email, alec@𝗬𝗨.com. You could also just reach out directly to any of our team members. They're fantastic. But yeah, any way you want to reach me, please do.
Okay. Thank you.
Thank you, sir.